Today we're going to talk about hedging strategies and derivatives, the tools and techniques that are used for risk transfer. We're going to build on our discussion of financial risk management in one of the videos that I parlayed with you a few moments ago. We're going to talk about derivatives, the financial contracts whose value is derived from underlying assets, rates or indices, whatever that might be. And these are the primary tools for this work. Understanding how they function, when to use them, and what accounting treatment they require is essential knowledge for the modern CFO. So let me begin by demystifying what is a derivative. And despite their reputation for complexity, the basic concepts are very straightforward. A derivative is simply a contract. It's a contract between two parties, and where the payoff is dependent on the future value of something else. It could be an exchange rate, it could be an interest rate, it could be a commodity price, it could be a stock index. The underlying exposure, it determines how the derivative behaves, but the derivative itself is just an agreement about the future payments. That's all. And the four fundamental types of derivatives are forwards, they are futures, they are options, and they're swaps. And each has distinct characteristics that make it suitable for different hedging purposes. So let me walk through each and every one of them. A forward contract is an agreement to buy or sell something at a specified future date for a price that is agreed upon today. Suppose you know you will need to buy 1 million euros in 3 months to pay a European supplier. You could then wait and buy the euros at whatever rate prevails then, accepting the uncertainty, or you could enter a forward contract today, looking at a specific exchange rate into the future. And then you purchase it at the future price. And when the 3 months pass, you exchange the dollars for the euros at the agreed rate, regardless of what the market has moved. So what the forwards do is it eliminates the uncertainty by fixing the prices today for a future transaction. And this certainty, it works both ways. If the market moves in your favor, you do not benefit because you're locked in. If it moves against you, you're protected. Forwards are customizable. You can specify exactly the amount, the date, and the terms to match your underlying exposure. They are typically traded directly between parties, often with banks, and also on exchanges. Future contracts are similar to forwards, but standardized and traded on exchanges. Instead of negotiating custom terms with a bank, you are buying or selling standardized contracts through an exchange that specifies quantity. It specifies a delivery date and other terms. And the exchange stands between the buyers and the sellers. You're guaranteeing performance and you're reducing the counterparty risk. So the standardization of futures, it creates that liquidity. You can easily enter and exit positions because there are many participants trading identical contracts. However, the standardization may not perfectly match your exposure. Why? Because if you need to hedge, and you need to hedge a specific amount on a specific date, futures may not align exactly, leaving some residual risk. And futures, they also have daily settlement, meaning the gains and losses are calculated and are exchanged each day rather than waiting until the contract matures. And this daily settlement, what does it do? It requires maintaining margin, cash deposits that ensure you can meet your obligations, and managing these cash flows, it adds operational complexity. So options are fundamentally a bit different from forwards and futures. An option, it gives you the right, but not the obligation to buy or to sell at a specified price. And this asymmetry, if you will, is powerful because if the market moves in your favor, you can let the option expire and benefit from the favorable movement. On the other hand, if the market moves against you, you exercise the option and you are protected. So consider a call option on euros. This gives you the right to buy euros at a specified strike price. And if the euro strengthens beyond your strike price, you exercise the option and buy at the favorable locked-in rate. On the other hand, if the euro weakens, you let the option expire and you buy the euros at the now cheaper market rate. You have protection against unfavorable moves while retaining the benefit of the favorable ones. And this attractive asymmetry, it comes at a cost. You must pay a premium upfront to acquire the option. And the premium, it compensates a seller for taking on the risk that they may have to deliver at unfavorable prices. Option premiums can be substantial. It can be particularly when the volatility is high or when you want protection against large moves. Whether the insurance is even worth the premium depends on your risk tolerance and the specific circumstances. Swaps are agreements to exchange the cash flows over time. And the most common type is an interest rate swap, where one party, it pays a fixed interest rate and receives a floating rate, while the other party does the opposite. Swaps, they allow you to transform the character of existing obligations without changing the underlying debt. So let me give you an example. Imagine you have a floating rate debt, but you want the company to have fixed payments. So you could refinance into a fixed rate debt, but that may be expensive or complicated. So what do? You enter a swap agreement. You pay a fixed rate and you receive a floating rate. In other words, the floating rate you receive, it offsets a floating rate you pay on your debt. And it leaves you with an effective fixed rate. You have synthetically converted the floating debt to fixed without touching the underlying loan. Does that even make sense? I hope so. So the currency swaps, what we are doing is we are working similarly, but all we are doing is simply exchanging cash flows in different currencies. And they can be used to transform the currency denomination of assets or liabilities to access funding in foreign currencies or to hedge long-term foreign currency exposures. Now that we understand the instruments that we spoke about, we are going to talk about matching, fundamental principle. Your hedge should offset movements in your underlying exposure. Remember that. When the exposure is losing value, or for that matter, then you want to make sure that the hedge is gaining value and it matches. So the hedge is reducing the risk. Perfect hedges are rare in practice. It never happens, hardly. But your exposure may not exactly match available hedge instruments in amount, timing, or underlying reference. But it tempers the risk. A manufacturer exposed to aluminum prices may find that the aluminum futures do not perfectly track the specific aluminum alloy they purchase. A company with euro revenue spread throughout the quarter may hedge with contracts that settle on specific dates. And these mismatches, they create some kind of basis risk, if you will. The risk that the hedge does not perfectly offset the exposure. So basis risk is not a reason to avoid the hedging, it's simply a reality to understand and to manage around it if possible. Even an imperfect hedge typically reduces risk substantially compared to no hedge at all. And our goal is to understand what residual risk remains and ensure it is acceptable. So the hedge ratio is another important concept. You do not necessarily have to hedge 100% of your exposure. Hedging 50 or 75%, it reduces your risk while leaving some exposure to favorable movements. And many companies, they adopt these partial hedging strategies, particularly when hedging cost is significant or when they have some view on likely market direction. Layered hedging is a common approach for ongoing exposures. Rather than hedging all expected needs at once, what you do is that you're hedging progressively as the time horizon approaches. You might hedge 90% of the next quarter's exposure, 60% of the following quarter, and 30% of the quarter after that. What do? This approach, it averages into hedge positions over time. It reduces the impact of any single decision's timing. So let me turn into hedge accounting, which is one of the more complex areas of financial reporting. The basic challenge is simply this. Derivatives, they are marked to market. Their fair value is recalculated each period. And with changes flowing through the financial statements, the underlying exposure being hedged may not be marked to market in the same way. And this mismatch, it creates a little bit of volatility in reported earnings, even when the economic hedge is working perfectly. Hedge accounting is a set of rules, and it allows companies to match the timing of gains and losses on hedges with the hedged items, reducing the artificial volatility. But qualifying for hedge accounting, it requires meeting specific criteria and maintaining extensive documentation. To qualify, what do? You must formally designate and document the hedging relationship at inception, specifying the hedged item, the hedging instrument, the risk being hedged, and how effectiveness will be assessed. You must demonstrate that the hedge is expected to be highly effective and then regularly assess whether the effectiveness, it continues. So imagine if a hedge fails effectiveness testing, then you lose hedge accounting treatment and you must now mark the derivative to market through the earnings. And there are three main types of hedge accounting treatment. It's often called the fair value hedges, the cash flow hedges, and the net investment hedges. The fair value hedges, it addresses exposure to changes in the fair value of an asset or liability. Cash flow hedges addresses the exposure to variability in expected future cash flows. And the net investment hedges, they address the exposure to the currency fluctuations in the foreign operations. So each has specific accounting mechanics to determine whether gains and losses are recorded. And I want to be direct about something. Hedge accounting is very complex, and the documentation and the testing requirements, they are demanding. And some companies, they decide that the benefits of hedge accounting, it does not justify the administrative burden, particularly for smaller hedging programs. So they accept the earnings volatility from marking derivatives to market, knowing that the economic hedge is sound even if the accounting treatment creates noise in the reported results. Whether to pursue hedge accounting is a judgment call, by the way. It balances a desire for stable reported earnings against the cost and complexity of compliance. But neither approach is inherently right or wrong. What matters is making an informed choice and communicating it clearly with stakeholders about how hedging activities affect financial statements. Let me also discuss counterparty risk, and I've spoken about that in the last session. Counterparty risk in derivative transactions, when you enter a derivative contract, right, you're relying on the other party to perform their obligations. And if they fail due to bankruptcy, for example, you may lose the benefit of your hedge precisely when you need it the most. And during financial crisis, this counterparty risk can become very acute. Managing counterparty risks involves several practices. First, deal with creditworthy counterparties, major banks with strong credit ratings and solid balance sheets. Second, diversify across multiple counterparties rather than concentrating with one. Third, use collateral arrangements where parties post margin to secure their obligations. Fourth, consider using exchange-traded instruments where the exchange clearinghouse, it stands behind all of the transactions. So I want to close with some practical guidance now on building a hedging program, if you consider doing so. Start first of all with a very clear policy. What are the exposures that you want to hedge? What instruments are being permitted in the program? What are the hedge ratios and time horizons will you target? Who has the authority to execute transactions? Document all of these decisions in a board-approved policy that creates a clarity and prevents ad hoc decisions that may not be thoughtfully considered. Ensure that you have the operational capability to execute your strategy. So that might include relationships with bank counterparties that are safe, systems to track the positions and valuations, and expertise to execute and monitor transactions in a timely manner, and accounting resources to handle the reporting requirements. Now, do not adopt a hedging strategy that exceeds your organization's ability to manage it. Keep it simple, and keep it simple as possible. The most sophisticated derivative structures are rarely necessary for corporate hedging purposes. Plain vanilla forwards, options, swaps can address 90% of the exposures effectively. Exotic instruments may offer marginal benefits but introduce so much complexity, so much model risk, and accounting complications that the cost outweigh the benefits. And finally, understand all of these instruments and be able to communicate clearly with your board and leadership about what you're doing and why. Hedging results should be reported in context, explaining not just the gains or losses on derivatives, but how they relate to the underlying exposures being hedged. And this holistic view, it helps stakeholders understand whether the hedging program is serving its purpose. Now, derivatives have acquired a very fearsome reputation, because of all the stuff that happened in the financial disasters. But again, used properly as tools for reducing risk rather than speculating, they're valuable and appropriate for many companies. So the CFO who understands these instruments and uses them judiciously and provide genuine protection to the organization, those CFOs are extremely valuable. So I hope this was helpful, and the video before on financial risk management, and you need to combine financial risk management and the hedging strategies and bring it together. And it is only when you bring it together you get the full framework, the capital framework, the capital allocation framework, and the bets that you're going to take in terms of the exposures that your company is undertaking. So I hope you found this valuable, and if you have any comments, please drop a note below and reach out to me, and I'll be more than happy to respond, and hopefully you'll attend more sessions. Take care. Bye-bye.